While Americans were celebrating the 4th of July, the markets kept moving. The Iran conflict appears to be shifting into a different phase. Oil has come off its recent highs. Gas prices have eased from where they were a month ago. Mortgage rates are still sitting on the mid sixes. And once again, the same question shows up. What happens when global events start flowing straight into your everyday budget? I'm Kyle Grimshaw, and this is the Texas Market Brief. Good afternoon and welcome back. I'm Kyle Grimshaw with the Grimshaw Home Group. Today is Monday, July 6, 2026. We didn't post on Friday because of the 4th of July holiday, and I hope you had a safe and meaningful weekend with family and friends. But while the country was celebrating, the stories kept moving. And today, I want to talk about what actually changed. Yes, that includes Iran, it includes energy, and it includes mortgage rates. But more than anything, this is about how quickly global headlines can turn into local math. Let's get into it. Let's start overseas. I would not describe the Iran conflict as fully resolved. That would be too strong. But it does appear to be moving out of the most immediate phase of escalation and into something more fragile, more technical, and more market sensitive. The focus now is shifting towards negotiations, shipping through the Strait of Hormuz, energy flows, and whether this framework can actually hold. That matters because the Strait of Hormuz is one of the most important energy choke points in the world. Roughly one-fifth of global oil and LNG trade moves through that corridor, according to Reuters. So when that route is threatened, markets react quickly. And when shipping stability starts to improve, markets react to that as well. That's a big reason oil has eased from the highs we saw during the most intense part of the conflict. Reuters reported last week that traders were watching whether US-Iran peace efforts would hold, with price stabilizing as diplomacy continued. But here's the caution. A calmer market is not the same thing as a settled situation. A negotiation phase is not a permanent peace. And when you're dealing with energy, shipping, geopolitics, the market can go from calm to reactive very quickly. So yes, conditions look a lot better than they did, but I would not confuse better with safe. Now let's bring this home. One of the biggest stories over the holiday weekend was travel. AAA projected 72.2 million Americans would travel at least 50 miles over the Independence Day holiday period, and 61.4 million of them were expected to drive, according to AAA. That actually matters, and gas matters more than what people think. Not because cheaper gas solves inflation, it doesn't, but because it changes behavior at the margin. As of today, AAA's national average for regular gasoline is $3.79 a gallon. That's still not cheap, but it is down from $4.19 a month ago. That kind of move doesn't transform the economy overnight, but it does give households a little breathing room. And when families feel a little less pressure at the pump, that money tends to show up somewhere else. Restaurants, hotels, retail, entertainment, day trips, weekend travel. That doesn't mean everything is suddenly healthy, it means pressure eases a little. And after the last few years, a little relief still matters. That's how I would frame it. Not a reset, not a celebration, just a little more room in the math. Now let's connect the dots. Oil affects fuel, fuel affects transportation. Transportation affects costs across the economy, and costs across the economy eventually show up in inflation. That's why energy matters even if you never look at an oil chart. It eventually shows up in your cost of living, and that brings us back to housing. Freddie Mac reported that the average 30-year fixed mortgage rate was 6.43 as of July 2nd, down from 6.49% the week prior. That's directionally positive, but let's be honest about what it means. A 6.43% mortgage rate is better than a 6.49 by a long shot. It is not some major affordability breakthrough though. It's still a mid-six handle, and mid-sixes still feel expensive for a lot of buyers, especially once you layer in taxes, insurance, HOA dues, and the rest of the monthly payment. So yes, some of the pressure has cooled a bit, but no, this is not a victory lap. That's the difference between a better headline and a better reality. And right now, reality is still expensive. Let's bring this back to the real estate market. When fuel costs ease, consumers often feel a little bit more comfortable. When mortgage rates soften, even slightly, some buyers start paying attention again. And when inflation fears cool, sentiment can improve. All of that helps, but housing affordability is still a math problem. Prices matter, rates matter, taxes matter, insurance matters, income matters, and inventory matters. That's why I think buyers need to stay disciplined right here. The question is not, did rates dip a little? The better question is, does this house make sense for my numbers, my timeline, and my life? And for sellers, the question is not, is the market back? The better question is, am I priced for the market we actually have? That's the difference between hope and strategy. And in this market, strategy wins. Now, let me zoom out for a minute. We just celebrated Independence Day, and I think this is actually a useful time to ask a bigger question. What changed while we were celebrating? Not just in the headlines, in reality, because the stories we keep covering are all connected. Energy security, housing affordability, infrastructure, artificial intelligence, digital money, the courts, immigration, jobs. These are not isolated topics anymore. They are all part of the same operating environment. And America still has enormous structural advantages. We have capital, energy, land, universities, innovators, entrepreneurs. We have people who still want to build, work, invest, and take risks. That matters. But optimism only means something if the systems underneath it can actually hold. That means housing people can afford, infrastructure that can handle growth, energy systems that stay reliable, policy that can keep up with technology, and communities that can absorb change without losing what made them strong in the first place. That's really what the assignment is now. Not just growth, execution. Here's my take. I'm still optimistic about America, and I'm still optimistic about Texas, but my optimism is not based on the idea that things are easy. It's based on the idea that we still have the capacity to solve hard problems. The question is whether we have the discipline to do it. The Iran conflict reminded everyone that energy security still matters. The holiday travel numbers reminded us that American families still want to move, gather, spend, and live. Mortgage rates reminded us that affordability is still a serious issue. And the 4th of July reminded us of something bigger. This country has never been a finished product. It has always been a project. That's not a flaw, that's the responsibility. The goal is not to pretend the problems are small. The goal is to build systems strong enough to handle them. And that is exactly what I'll be watching as we move through the second half of 2026. I want to hear from you. After this 4th of July weekend, are you feeling more optimistic or more concerned about where America is headed and why? Leave a comment below. I'd genuinely love to hear from your perspective. And if you found today's episode helpful, make sure to subscribe. And if there's a topic that you want me to break down in a future episode of the Texas Market Brief, let me know in the comments. I'm Kyle Grimshaw with the Grimshaw Home Group. Thanks for joining me this afternoon. Have a great week, and I'll see you on Wednesday.